Amy, and welcome everyone. So excited to be with you today in December. We're expecting to get some snow here in Colorado, so preparing for that. My name is Shannon Smith, and we are going to be talking about considerations for nonprofits that have international projects or remote workers. And just to tell you a little bit about myself, I am the partner that leads the International Tax Services Group for Eide, and we have 20 people around the country that are specifically just focusing on international tax. One of our favorite areas is helping nonprofits with their missions and pursuing those globally as well. And so I am based in Colorado, as I mentioned, and have been with Eide for 10 years and super excited to be with you here today. So on our agenda, we are going to talk about just in general international projects and some considerations around those, mostly focusing on some tax issues that we see organizations running into on a regular basis. And so we just want to highlight those. And we also will talk about having remote workers abroad. Of course, with the pandemic, we have seen a huge increase in questions about, well, if I have an employee that wants to work remotely from, let's say, Spain, what does that mean for me? And so we will talk about that because it is such an important topic to think about and talk about and hopefully get some advice around before pursuing that. And then finally, we'll wrap up with some compliance considerations because we can do all the planning, but we also need to make sure that we're staying out of the penalty realm with all of our compliance. So with that, we will get started on just talking through international projects. So oftentimes we see a lot of different areas where we're looking at expanding the activity of the organization outside of the US. The items that we see a lot of are, for instance, hosting seminars, and that can be having those seminars be online outside of the US, also having non-US people providing that content as well. And sometimes it's a mixture of both of those. And then also sale of goods. So oftentimes organizations will have some type of goodies that they're selling or items that help in the pursuit of the mission of the organization. And so we do find that organizations are often running into indirect tax issues related to sale of goods. So we'll talk a bit about that. Of course, technical assistance. That is where maybe an organization is just providing some advice around how to do something that is related to their mission. And so that is typically what we're seeing here is the assistance is being provided from the US, but there are oftentimes foreign locations, foreign related entities that are requiring that assistance. And then also licensing. So many organizations, in terms of their expansion into the global market, they might not do that directly. Instead, they may license their content, their name, their know-how, etc., to other organizations as well. So we see that quite a lot, and we'll talk through some of those issues as well. So going into an international market, international space is really, you're really going to have a lot of balls in the air. So this is just thinking through some of those things, you know, what is the product or service that you're going to be providing outside of the US? Location, you know, in terms of, are you setting up an office, or is it simply just selling into another country or providing some services into another country? One of the really most important, and I always encourage folks to get working on this right away, is just the legal and regulatory issues. So are there patents that need to be, or sorry, are there trademarks that need to be protected, et cetera? And how does that work in a global environment? And then tax, we're going to spend most of our time today on some of the tax issues that arise. People, of course, who's involved. Do you have a point person in your organization, somebody that can keep track of if you're going into multiple countries, seeing, you know, what those differences are, and having really a team of people that are the go-to for those projects is really important. Insurance may not be as large of an issue related to nonprofits, but if you have employees outside of the US, that's certainly important. And then, of course, the financial aspects, so the reporting of that activity on your financials. These are some of the, like I mentioned, legal and regulatory items. So it is super important to get these areas covered. So entities oftentimes will need to do business registrations in another country. And I say business, I view the activities of a nonprofit certainly as a business. And those oftentimes need to be registered if you are having an activity. Entity selection, so that is talking more about if you do need a legal entity in another country and what that looks like. Employment agreements, if you're employing folks outside of the US, and we'll talk a lot about that. Well, a lot about the employees with our remote employee topic, as well as the immigration issues. Also, one item that is key in your industry is the event and supplier contracts. So oftentimes the laws that you know, we're used to, and the contracts that we have that we might be setting up with our US companies are not the same, or they need some adjustments for the global environment. Also, import and export regulations, that would be something that you would need to be thinking about with respect to any goods that you're selling. And also, I mentioned as well, intellectual property protection. So a lot of times there's trademarks, there's know-how, and getting an attorney involved right up front. You generally will need one here, and you'll also probably most likely need one in the other country, because US attorneys aren't necessarily able to provide that legal advice. Just like tax advisors, oftentimes, such as myself, I work with other folks around the globe to help our clients in managing going global. And so we have a network of firms called HLB that we will enlist to help us with all of the aspects on a tax basis, as well as accounting, if there's payroll that's needed, and other things of that nature. Okay, let's move on to minimizing the tax risks and costs. So of course, the goal oftentimes, or yeah, the goal of nonprofit organizations is to not have to pay tax, so that they can have more of that money to further the organization's mission. And so that's a key consideration in terms of going global, is we want to reduce and minimize the impact of any non-US tax system. And so the way that we look at projects and advise our clients is really looking at 3 different areas of taxation. One is indirect tax. I say indirect tax because there are a lot of different things that it can be called. One of them is state and local sales and use tax. So in the US, we have sales and use tax. There are a couple of other countries that do as well. And the sales and use tax is something that is ultimately charged at the consumer level. And in other countries, there is something called the VAT, which is value added tax. A VAT tax is very similar to a sales and use tax, in that it's on the value of the good. However, in this system, that tax is assessed along the way, so along the supply chain. And so I'll go through an example of that so you have a better understanding. But it's often one of the first types of taxes that our clients come to us asking about, because the consumer or whoever is engaging with you in another country is likely going to have some information to provide, and may even ask you about whether you have a VAT number, VAT registration number, etc. And so that's usually where the question comes up first. The second area is individual tax. And so a lot of times when companies are having activities in other countries, there's an individual that's either visiting, maybe visiting on a regular basis, maybe also you may find individuals that are actually relocating. And so all of those types of individual issues pop up, and we need to be careful about creating taxable presence for them and for the company as well. And then, of course, corporate income tax. That one is also super important for us to be mindful of, because in the US, a non-taxable organization is trying to, of course, doesn't want to pay foreign tax. So in the corporate side of things, in a taxable organization, you would generally have some sort of mechanism so that you don't have double taxation. So there's like a foreign tax credit. Obviously, that doesn't apply if you're not paying US tax. You're not going to get a foreign tax credit. And so that is a bottom line cost to the organization. So we want to avoid that as much as possible. And so we're going to talk quite a bit about that as well. So some of the potential exposures, and this sort of wraps up all of what was shown in that triangle. When organizations have employees spending time in another country, there are the potentials to create obligations, one for the employer in withholding on foreign income tax and reporting foreign income. Second, for the employee, so where they may need to file a foreign income tax return and pay foreign tax, and then deal with how that impacts their US return, and hopefully not causing double taxation there as well. Also, the organization may need to register for business in a foreign country. And that, of course, is one of the first things that you'd want to do to make sure that you are legally able to do or to provide your service or expand your activities in another country. And then also organizations will need to comply with foreign tax filings where they are applicable. So I'll start first with the corporate income tax considerations. When we think about corporate income tax, the first question is, when will that activity create taxation in another country? One thing that I like to just stop and note here, which we oftentimes just need to remind ourselves that just because an organization is qualified to be tax exempt in the US, that exemption does not necessarily apply in a foreign country. So we have the same thing when organizations come to the US and want to pursue their mission here, they need to get the same exemptions that a US nonprofit would need to. And so we want to make sure that in most cases, you're not going through that process to become tax exempt in another country. And so we need to be careful about whether we're creating taxation in that country. So there are the one key term that we use in international tax is permanent establishment. And that, if you're familiar with the term nexus, is very similar, where permanent establishment is really a fixed place of business where the organization's business is carried out. And oftentimes, even some things as an individual that may be working from home has the potential to create a permanent establishment or a taxable presence for the entity. Also important is that we have treaties and double tax treaties with many countries, and whether the organization could create a permanent establishment also is impacted by the treaty. So first we look to their domestic law. If it's possible that there would be a permanent establishment or a PE, then we look to the treaty to see if there's some relief there. And oftentimes there is, it's mostly the fixed place of business where the organization is carrying on that business. Oftentimes in some countries, there's also services permanent establishment. So there might not be a fixed place, but there's substantial services being provided in the country, and that can cause it as well. Then we also just need to think about Well, in terms of the permanent establishment, what activities are happening outside of the US and understanding those and how they could create a permanent establishment. So sales, for instance, this doesn't come up as much in the nonprofit space, but you can have agency relationships that create a PE. That meaning that you have hired somebody that's going to do business on your behalf. So that oftentimes happens in the sales realm where you're enlisting somebody that's going to be an agent for you in that country, and that can cause a PE. Of course, services, so that's mostly where we're having individuals that have a fixed place. Maybe they set up an office space. It could be a WeWork even type of place that creates that fixed place. And then, of course, e-commerce. One tricky thing about e-commerce is that, you think that you're just selling things into a country from abroad and you don't have a permanent establishment. One gray area that comes up quite a lot is if there is a server that is established in another country and you're using that server, that has the potential to create a PE as well. And that's a very gray area and not very well traveled. So something else to be thinking about. So in terms of the tax treaties, I mentioned that we have the permanent establishment concept. I also mentioned the services PE concept related to other countries, some countries. One of them is Canada. So we need to be really careful when we're doing business in Canada related to that. And then also in terms of employees, if you have an employee that's working overseas and maybe working from home or from an office, if they have the authority and they regularly exercise that authority to enter into contracts on your behalf, then that can create a permanent establishment as well. Next, I wanted to just talk a little bit about licensing. So licensing is something that we see very often in the nonprofit space. And so I think it's important to talk through how that could create an income tax obligation for you. In terms of income tax, this is just the way that it's assessed is typically withholding tax. So you might not have a physical presence, you might not have a permanent establishment, but if you are licensing to a non-resident of the US, most countries have withholding taxes. Withholding taxes allow the country to have the ability to assess tax on a non-resident that is accruing income from their country. So the US has withholding taxes as well. So we need to be really careful about those because again, those withholding taxes can become just a bottom line cost to your organization. So one thing that we want to be mindful of in the withholding tax space is that when we are when we are entering into licensing agreements, that is the best time to determine what the withholding tax potential could be. One of the reasons for that is that there is often the ability to adjust the license amount, the licensing amount. So let's say it's 5% of membership fees, etc. Well, if there's a withholding tax on that, that might make the organization think about whether that should be 7% instead because of that extra cost to the organization. So generally, what we look for in the licensing agreement is, whether it's considered a royalty, and also we can look at the treaty to see what the taxation of those licensing agreements are. Most of the time, a treaty is going to reduce the withholding tax. So let's say you are licensing something into the UK and the withholding tax just generally on payments, licensing payments is, let's say it's 30%. That's 30% off the amount that you would typically get. Under the treaty, that might be reduced to say something like 5%. And so that's something that we want to also make sure that we are looking at. One issue that we oftentimes have as well is just looking at whether the organization qualifies for benefits under the treaty. So that's really important to look at as well. Okay, let's talk a bit about indirect tax. So as I mentioned, the most popular that you would see outside of the US is the VAT. That's a value added tax. And it also applies to services and digital products. So when you think about in the US, typically sales and use tax only applies to goods in most places. There are, of course, exceptions, but more and more taxing jurisdictions are trying to tax at the level of where that service was provided or where that digital product was provided. And so in most cases, the VAT is going to be applicable in those instances as well. Two countries, Canada and Australia, I think there might be a couple more, have what we call a goods and services tax. Goods and services taxes pretty much the same as a value added tax. And the HST is a Canadian term for harmonized sales tax as well, just because they have a number of different provinces, and each province also assesses its own tax or can assess its own tax. Not all of them do. So just some terms to be familiar with. So one thing that I like to do is just give an example of how the VAT works. And this is more in an example of, a manufacturer that manufactures something and then it gets sent to a retailer and then that gets sent on to a consumer. But if you think about it from a nonprofit's point of view, this could, the retailer could be your organization. So I'm going to think of it that way, but wanted to point out, so let's say that a supplier is supplying raw materials. Let's use I'm going to use a manufacturing because usually it's like pamphlets or some sort of physical good. So they use raw materials, and those raw materials are produced by the supplier and then sold onto the manufacturer. So let's say those supplies were sold to the manufacturer for, you can see on the left bottom, $1,000. And the VAT rate is 20%. So we're going to assess that VAT and the invoice, and that's going to go right on the invoice, and the invoice is going to go to the manufacturer at $1,200. Then what happens is the manufacturer is going to go ahead and sell those goods onto the retailer after they have manufactured and added some more value to that, that product. And they're going to sell that product at $1,500 because they've added some additional value to it. They're going to assess again that 20% of $300. And so the invoice is going to be $1,800. And if we go to the top there in the middle, you'll see there's VAT of $300. So that's how much they charged their customer, the retailer. And then what they get to do is take a credit for the amount that they have already paid via the invoice that they paid to the supplier. So they get a credit for the $200. So the net is the value, the tax on the value add that they have added to the supply chain. So that is really how it's working. And at the end of the day, all of that gets passed on to the consumer. So the consumer, and it may be, another organization, it may be that you're selling directly to customers, maybe via an online platform, etc. And so that's where that would end up. So when will indirect taxes apply? So they certainly will apply to the sale of goods and some services, as well as providing a provision of digital content, which is relatively, it's kind of a gray area, but it's relatively new, and the EU has implemented some additional rules related to digital content as well. And so it does apply to charities. Treaties are not applicable. So I've talked about double taxation and reducing taxation via double tax treaties. They're not applicable to indirect tax. And so one thing to keep in mind is that NGO goods and services may be 0 rated. So that may be that you need to file a VAT return or VAT tax return, but that activity may be 0 rated, which means it's nil. But you can still take that input credit if you needed to. So one other item that I wanted to mention is that in many countries, they have what we call a reverse charge mechanism. So if you're selling something into another country and it doesn't meet a certain threshold, so a lot of times there are thresholds of, how much are you selling into that country? Oftentimes the customer will reverse charge, meaning they will charge the VAT on themselves and pay that into the tax authority when they import the good. So that is typically going to happen if you're selling to organizations. Individuals, however, generally are not going to be doing that. And that's where the relatively new rules are coming into play, where countries are saying, if you have sales into my country of more than X amount, then we are going to require that you register for and remit VAT taxes on the sales to those consumers. So one thing that is relatively, a very big hot topic related to just other countries capturing taxation via the indirect tax, because the income tax may not apply. All right, next we're going to move on to individual taxation. I'm thinking of a few different examples. There could be examples where individuals are just going. They may be in a country for a couple of weeks because they're setting up a seminar. They're working with people on the ground there. It also could be that you're sending somebody for a few months to work on a project to further the mission of an organization. And so what we need to be careful about with individual taxation is the withholding tax on the foreign income. So there could be both employer and employee obligations with respect to income tax. And just like in the US, if you're paying an employee, the employer has a portion that they need to apply, as well as the employee portion that you're required to withhold as well. We do have some tax treaty applications with respect to that. And in your space, I would say that most of what we see, the tax treaty would apply. And so there wouldn't be taxation on the individual, because the general standard number of days that they allow for you to be in the country without being taxed is 183 days. So that is, it's a general rule, and each treaty is different. So we do have to look at each treaty in order to give advice around whether it applies. But also keep in mind that how they count the number of days varies by treaty, and varies by country. So it could be that they look at it in a rolling 12 months, and it could be that they look at it on a calendar year. And also one item that is mostly missed in our taxable entities is the employer can't have a taxable presence in the other country in order for this treaty application to apply. So I am going to, let me see what's, we have a couple of questions. So I think I'll wait until the next polling question, and I'll talk through those for you. Okay, short-term business travelers. Important if you're getting into a space where you are having a lot of travel, having a lot of folks spending time in other countries, to be able to track that. You want to be able to track that both for the individual taxation side to make sure we're not running into a taxable presence for them, but also on the income tax side, also withholding for the employer tax side. So one thing that I like to point out is oftentimes we will see, organizations that they're having a lot of travel, and they're not really keeping track of things. And so we want to make sure that we're just avoiding the surprise of an individual that's coming through customs and they get asked some questions and that results in them being detained. So we don't want to have that. And so we want to just make sure that we're being careful and also educating the organization around what those rules may be and what they need to be watching out for. So you can use things like expense reports, travel agent reports, and also calendar tracking, which seems a bit big brotherish, but okay. Thank you for clarifying. It was, what do you need to qualify as a charity in that country? I don't believe that there is a particular website that summarizes it, but usually you can find that on the IRS's, the equivalent of the IRS's website. And if you ever did want to inquire into that, we, like I said, we have a network of firms, and we can reach out to them to see what that entails to get that qualification. So yeah, I would go onto the equivalent of like the IRS and look for those provisions there. All right, on to remote workers. And as I mentioned, because of the pandemic, we really are seeing an uptick in this question being asked. And so I wanted to spend some time here. Some of the questions that you'll want to consider, oftentimes too, it might be an employee wants to live in another country and work in another country, not necessarily because you want to be present there, but just because that's where they want to live. And so this is coming up quite a lot now that, things, it's a little, I don't want to say it's easier, but people have become accustomed to the ability to work remotely. So, so that's where that's coming up. So some questions. One is, will the employee create a taxable presence for the organization? So that's going back to that corporate income tax and indirect tax question of, have we created a taxable presence there? And so oftentimes it depends on what that person is doing, how long they're going to be there. And so we need to ask some questions around that. Secondly, is the organization required to register to do business or obtain permits? Oftentimes, if you're going to have an employee in another country, you are likely going to have to do some sort of registration there. So that, again, is an area where you want to have your legal advisors involved to make sure that you have the proper business registrations and permits. Then next, it would be, will the employee become a tax resident in that country? So oftentimes, if an individual wants to go on their own accord to another country and work, oftentimes you wouldn't be doing this. But if you did have an employee that created a taxable presence for themselves and you're required to do some things around that, you might even help with their tax return preparation. That's generally only happening when you are requiring the individual or the employee to go somewhere. So, and with respect to the employer obligations, and this is where organizations usually say, whoa, we don't want to do that. That's going to be costly. That's going to be complicated. And that is around the withholding taxes. Oftentimes there's, like I said, an employer portion and an employee portion of the tax that needs to be paid. And so if you have an employee in another country, you would need to register with a tax authority to withhold and remit those taxes over to the tax authority. There are also employee benefit issues and labor law issues that we see, especially in European countries. Labor laws are much more employee favorable, and you need to be very careful about making sure that you're meeting all those obligations so that you don't get the organization in trouble. But we also have organizations that so this is relatively new. Well, increasing, I would say, in volume of organizations that can employ individuals on your behalf. So those are generally called PEOs, or professional employer organizations. They have those on an international basis as well. And if you were to ever want a referral, we have a few that we can get you in touch with, but they would basically take care of the withholding taxes. They would do all those registrations. They would make sure the employee has all the benefits that they need that are required in that country, and also advise on the labor laws, or make sure that they're in tune with the labor laws as well. So a lot of things to consider. Usually what happens is we have consultation with an organization, and we talk about what those employer obligations are. And unless it's somebody, you know, that's really key to the organization, it's pretty expensive to do that. And so a lot of times they back off from that and say, sorry, we're not gonna, you know, allow that to happen. Unless it's, you know, really important and key to furthering the mission of the organization. So next, I'll go into compliance. I have a couple more questions that I will address. So one is for travel expenses, the organization's reimbursement us the travel expenses. What should we record those income as other income, or deduct travel expenses? I think this question is asking if the employee needs to record a reimbursement of travel expenses as income, and they do not. So long as it's you know, regular business travel, those can be reimbursed without being included in income. If you have an expatriate, so somebody that's actually moving somewhere for a period of time, and the organization is going to pay for some of the expenses, so oftentimes they may pay for you to rent an apartment, to have a vehicle, because you know, you need to kind of replicate your life there, and those items are includable in taxable income. But in that case, oftentimes too, we have some exclusions, foreign income exclusion, and living expenses that may be able to be excluded as well. So if I didn't understand that question, feel free to pop in and clarify. So if not restricted, can we book it as unrestricted general? Oh, these are accounting questions. So I see where this is going. Okay, so in terms of how you're booking it in the financials, I apologize, but I cannot answer those questions. But I can definitely put you in touch with somebody that can. So Faith, I can connect you with somebody after this to ask those questions. So all right, let's move on to the compliance items. Lots of compliance. As per the usual, the U.S. tax authorities are very interested in what you're doing in another country. And so I will sort of walk through some of these items. The key thing to know is that there are very large penalties that can go along with these forms. So again, being in front of it, asking in advance what forms you need to be filing is really important. So some organizations actually set up other entities in other countries for a number of different reasons. It could be legal, it could be employment, etc. In those cases, there are reporting that we need to do with respect to those entities. Those are that first line of forms, the 5471, that's for corporations. 8858 would be an entity that we treat as disregarded. That goes into some complicated things, so I'll skip just explaining that in detail. But then the 8865, so if an organization is entering into a partnership, some type of partnership with another organization, there can be that 8865 as well. So key thing to note here is that the penalties for non-filing or filing these forms late is $10,000 per form per entity. So we want to be really careful about that. Also on the Form 990, we have a Schedule F, and the Schedule F requires you to talk about the activities outside of the US. So that's important to make sure that's included. And then if the organization needs to set up a foreign bank account, and they do so in the value of that foreign bank account is above 10,000 at any point during the year, then we have another form that needs to be filed. It's actually filed separately from the tax return, but we view it as part of the tax package. It's called the FBAR for short, but foreign bank account reporting, Form 11. 114. Okay, and then the last one is Form 5713, the International Boycott Report. I mentioned this one because a lot of our organizations that are expanding overseas are in a lot of the countries that have a boycott, and we are required, and mostly this is, you think of the boycotts on Israel, and if you are doing business in a country that has a boycott with Israel, then you're required to report that. And so that's a form that often gets missed, but I mention it so that you can be aware and make sure that that's covered as well. So foreign investments. Oh, oftentimes organizations, and this is less related to like pursuing your activity outside of the US, it's more related to you might have some investments with the funds that you have in reserve. You might have some investments there. So really important to talk with your investment advisor and understand whether there are any foreign investments there, because there are some definitely some reporting that may need to be done. And the most prevalent one that we see is called a PFIC, and that's a personal foreign the PFIC is basically an entity that has a lot of passive income, and you own less than 50% of it. And if it has a lot of passive income, then it would be considered a passive foreign investment company. Sorry, just came to me. And then we have the rules here around the PFIC are if it has 75% of its gross income is passive, or 50% of its net assets are passive. And if it has no UBTI, unrelated business income, then there is no reporting. And if the value of the stock is less than 25,000 or 5,000, if it's indirect, then there's no reporting. So just be aware that you may receive some information from your investments around a PFIC. If you have those questions, you can certainly we can certainly help with whether that needs to be reported. But again, there's another form that needs to be filed if there's unrelated business income. So with that, I think we have, other compliance requirements. So things to think about, and I think I've talked about most of these: registrations, business registrations, licenses and permits. Also, there's some anti-terrorism rules in the US, and so be cognizant of doing business outside of the US and needing to do some reporting around that with respect to your activity. One of them is a BE10, which is basically reporting that you have a foreign entity, and so you're providing some information. A lot of it's the same information that you would be reporting on, say, let's a 5471, but it's a little bit more detailed, different organization. It's actually not a tax form per se. So some other things to be thinking about for compliance. So I just want to end on a little plug and talk to you, or just mention again, the network of firms that we belong to is HLB International. It's a very large network, and a lot of the organizations that are in that network are, well, they're mostly accounting firms, but there are some legal firms as well, and some other business services. And a lot of most of the countries that we're in they have similar type of clients as we do. So it's a really good fit for our client base. And so would encourage you, if you do have questions about going into another country, if you wanted to check out their website. It's I've noted it there, but also you can feel free to reach out to me. And I am on the International Tax Committee for the network, and so I have really good connections and can get you connected with the right folks in those countries. So with that, I think we are done, and I don't see any other questions, but feel free to pop in and ask a question if needed.
All right. Well, I don't see any right now, so that is all right. Thank you all so much for attending. Thank you, Shannon, so much for presenting, and we hope that everyone has a great rest of their day and a holiday season, and we will see you in 2023 for our next nonprofit webinar. So just again, thank you so much, and we hope you have a good rest of your day.